Here is an overview of the different risks a bank or a financial institution could be exposed to. We're going to take some time shortly and explore all of them. As you can see, they can broadly be categorized into two groups: financial risks and non-financial risks. Financial risks are risks that are reflected in the financial statements, usually the balance sheet of a bank. These risks usually arise as a result of their risk-taking activities day to day. Financial risks are market risk, credit risk, counterparty risk, and liquidity risk. Non-financial risks are risks arising from a bank's operations and are similar to risks faced by companies in other industries. These risks include operational risk, model risk, compliance risk, conduct risk, reputational risk, and ESG risk. Investment risk is describing a specific example of risk found in the investment management industry, and we'll explain this risk in more depth towards the end of this chapter. Okay, if you're ready, let's get into some specific examples of risks in banking, and let's start by exploring market risk. Banks, especially investment banks or universal banks with investment banking divisions, often own financial instruments like stocks and bonds and derivative contracts for relatively short periods of time to help them with their day-to-day business. An investment bank might buy and sell Apple shares or US Treasury bonds to its clients. They would describe this service as being a market maker. They will need an inventory of Apple shares and US Treasury bonds to do this, just like an electronics store needs computers and tablets to sell to their customers. Banks record the value of these financial assets on their balance sheets. Financial assets are valued every day in a process called marking to market. Market risk is the uncertainty banks face due to movements in commodity prices, equity prices, interest rates, credit spreads, and foreign exchange rates. These movements will impact the value of stocks, bonds, and derivatives they own and record on their balance sheet. The larger the potential future movement in the market price of a financial asset recorded on its balance sheet, the more market risk a bank is exposed to. This is because the future value of that financial asset is harder to predict or more uncertain. This concept is referred to as volatility. Banks offer lots of different types of lending products. For example, retail banks will offer mortgages so its customers can purchase houses, or consumer loans so that they can purchase things like computers or cars. Retail banks will also offer products such as overdrafts, which in effect is a type of lending product. Commercial and corporate banks also offer lending products to their clients, from company credit cards to short-term lending facilities, so businesses can purchase new inventories or pay suppliers. These banks will also offer longer-term lending products, so businesses can invest by buying new factories or new equipment. Commercial and corporate banks may also team up with other lenders to lend money in large infrastructure projects in a process referred to as syndication. An investment bank may lend money to a hedge fund client to help support a specific trading strategy. Or an investment bank may lend money to a client looking to undertake a leveraged buyout. A leveraged buyout, or an LBO, is when one company purchases another company using a significant amount of debt. The wealth management division of a bank will offer lots of different lending products to its high net worth clients, from loans to purchase a house or a holiday home to loans to help their clients extend or grow a family business. All of these products expose banks to credit risk, or the risk that their customers fail to repay their loans, resulting in a financial loss to the bank. In fact, just to be a little bit more specific, this type of credit risk is also known as default risk. As you can see, because of the scope Of all these different types of lending products, credit risk or default risk is often the single biggest risk a bank is exposed to. There is another type of credit risk, counterparty credit risk, or just counterparty risk for short. Counterparty credit risk is an issue for banks engaged in financial market transactions with other counterparties. These counterparties could be investment banks, asset managers, hedge funds, and universal banks with investment banking or investment management divisions. In financial markets transactions, there are two parties, a buyer and a seller. Once the terms of the trade have been agreed by the parties, each party has certain obligations. The buyer has to deliver the specified amount of cash. The seller has to deliver the specified asset, for example, a stock or a bond, in the specified quantity. Counterparty risk is the risk that a bank's counterparty fails to meet its obligation in a financial markets transaction, resulting in a financial loss to that bank. Businesses today are large and often complex organizations. This is especially true of banks. While banks can range from relatively small regional banks, the reality is most of the banks that we read or hear about are large universal or investment banks, with operations in dozens of countries, offering a range of products and services to a broad range of clients. These banks must have clearly defined processes and systems in place to avoid errors and improve efficiency. There is a high degree of dependency on technology to achieve this. People need the right training and skills in order to effectively fulfill their roles. The bank needs to adopt an appropriate attitude towards risk to encourage employees to behave ethically and lawfully. Not only do banks need to manage these internal issues successfully, they also need to manage external events which might disrupt their ability to operate on a day-to-day basis. These external events might come from natural sources. For example, a bank might experience disruption due to damage to its offices or trading floors due to an earthquake or a severe storm. Severe weather events may also prevent a bank's employees from being able to get to the office. The external events might not come from natural sources. The disruption could come from hackers trying to access the bank's data, or a failure in a bank's third-party product. Operational risk is a broad category of risk, which results in a financial loss due to failed or inadequate processes, systems, people, or external events. The larger the bank, the more complex it becomes, and the greater its operational risk. Some of the most significant recent fines imposed on banks by regulators have been due to failures in their operational risk management. Some banks have a terrible track record in operational risk management, which has resulted in fine after fine, massively impacting that bank's financial performance and doing irreparable harm to that bank's reputation. All businesses need access to reliable funds in order to carry out its day-to-day activities. For example, expenses like salaries need to be paid, assets need to be purchased, and debt needs to be repaid. Businesses also have to have their funds in the right place at the right time, which can take a lot of effort and resources for large global organizations operating in dozens of countries. Funding for banks is different to funding for non-banks. A key source of funding is often customer deposits. But other sources of funding include borrowing from other banks, issuing bonds, trading liabilities, and equity. Trading liabilities are usually derivative contracts that the bank has entered into with other counterparties, where they are the party that owes money to the counterparty. Liquidity management is the process of managing the funding of the bank. And the risk that a bank gets its liquidity management wrong is called liquidity risk. Liquidity risk comes from one of two sources. The first is probably fairly obvious. It's when the bank can't access the funding it needs to operate on a day-to-day basis. When this scenario happens, banks can run into trouble very, very quickly. This inability to access funding, that is, liquidity, was one of the key reasons why Silicon Valley Bank failed in March 2023. And the second source of liquidity risk? Well, that's when a bank can still access the funding, but the cost of the funding is very expensive. And this leads to a loss in financial returns that the bank's able to generate. Banks and financial institutions rely more and more than ever before on models. In fact, large, complex banks have literally tens of thousands of models, all of which are recorded in their model inventory and are used to make decisions worth billions of dollars. So, what is a model? A model uses statistical, economical, financial, or mathematical theories, techniques, or assumptions to transform input data into outputs or results. Models can be created from various technologies, including C++, Excel spreadsheets, MATLAB, Python, R, SAS, and SQL or SQL. So what do banks use models for? Well, lots of things. For example, valuation and pricing models help traders determine whether an asset or security is over or undervalued. Market and liquidity risk models help risk managers forecast what future risk exposures are likely to be. Credit and counterparty risk models help determine the likelihood that a customer or client may default in the future. Finance models help banks project future revenues, cash flows, and profitability. There are two primary sources of risk when banks use models. The first is the potential for something bad to happen from decisions based on an incorrect or misused model. A model may have fundamental errors and produce inaccurate outputs, especially when viewed against their intended business use. The second source of risk is that while a model may not have any errors, it might be used incorrectly or inappropriately, or there may be a misunderstanding about its limitations and assumptions. For example, a model designed for pricing short-term debt instruments might be used for calculating the price of other securities. The model works exactly as it should for its intended use, pricing short-term debt, but it's being used incorrectly. Compliance risk is the risk that a bank incurs fines, has restrictions on it from doing business, or has damage to its reputation from not following or by breaking the laws and regulations in the countries where it does business. Compliance risk has a couple of important and closely related types of risks, which are important to define as it's easy to get confused about them. One subset of compliance risk is legal risk. Legal risk is the risk of potential legal actions being taken against the bank. Often, legal risk manifests itself as lawsuits against the bank. On the other hand, regulatory risk is the risk that a new regulation or law will be implemented, either increasing compliance costs for a bank or causing disruptions to their day-to-day business. Banks will often group legal and regulatory risks and manage them together with compliance risks. Conduct risk refers to the potential risk arising from inappropriate or unethical behaviour within an organisation that may harm its customers, stakeholders, or the broader market. It encompasses actions or behaviours that violate laws, regulations, internal policies, or ethical standards and can result in reputational damage, legal penalties, financial loss, and loss of customer trust. Conduct risk is particularly relevant in industries such as banking, insurance, investment management, and other financial services, where customer interactions, financial transactions, and the handling of sensitive information are commonplace. It focuses on the conduct of individuals and the overall culture within an organization, including the behavior of employees, managers, and senior leadership. Recent examples of conduct risk that banks have been fined for include selling products or services to customers that are unsuitable for their needs, engaging in activities to manipulate prices, such as insider trading or spreading false rumours to influence market behaviour, breaching client confidentiality, which violates privacy and damages trust, exploiting privileged inside information for personal gain, or engaging in fraudulent activities within an organisation. What can organisations do to mitigate conduct risk? Well, organisations such as banks typically implement robust compliance programs, ethical codes of conduct, and strong governance structures. They promote a culture of integrity, transparency, and accountability, provide training and education on ethical behaviour, and establish mechanisms for reporting and addressing misconduct. When customers decide to use a bank for their products or services, they are putting trust into that bank. Trust that the bank will treat them fairly, and trust that the bank will do everything it can to protect them and their assets. When shareholders invest in a bank, they do so on the basis that they expect employees to behave in a way that doesn't put their investment at risk. When other banks do business with the bank, they are doing so on the basis that they expect that bank to fulfill their commitments, and that employees will not behave in a way which jeopardizes those commitments. Trust is built up over a period of time through a bank consistently meeting its financial obligations and constantly protecting its clients while offering them a good service. In doing so, a bank enhances its reputation amongst its stakeholders, such as customers, shareholders, and regulators. A positive reputation has many benefits for a bank. It attracts new customers and helps to keep existing ones. Employee retention is increased, meaning the bank gets to keep top talent. Business partnerships increase. All of these factors ultimately lead to increased revenues for the bank. Reputational risk describes the risk that actions by an employee or group of employees, a transaction, or an investment that the bank makes damages the trust or the reputation of the bank amongst its stakeholders. While there is a degree of connectivity amongst all the risks a bank faces, this interconnectedness is really emphasized through reputational risk. What do I mean by this? When a bank fails somewhere in its risk management, this can lead to reputational risk. A bank whose fraud management leads to compliance risk can create reputational risk. Bad credit policies that lead to large amounts of loan defaults can create reputational risk. Outdated policies that lead to large amounts of failed trades are caused by operational risk, and again, this can lead to reputational risk. Relying on incorrect models can lead to poor decision making, again creating reputational risk for a bank. Ensuring that the bank has an appropriate risk culture is the most important weapon in mitigating reputational risk. Adopting an appropriate risk culture has many positive benefits for a bank. It results in employees and management adopting positive risk attitudes and exhibiting positive risk behaviours to ensure that decisions made today do not harm the bank's reputation in the future. Within the financial services industry, there are several players who take funds from their clients and invest those funds on their behalf. Examples include investment or asset managers, hedge funds, pension funds, and insurance companies. Let's group all of these different players under the one heading investment managers just for simplicity. These investments are subject to investment risk. Investment risk is the manifestation of market risk within an investor's investment portfolio. In other words, investment risk is the risk that an investor's portfolio might fall in value, resulting in an investor losing part or maybe even all of their investment. What's critical to understand here is that it's not the investment manager that's exposed to investment risk. If the fund that they are managing falls in value, it is the client, their investor, who bears this investment risk. There are different ways to classify investment managers. A common approach is to classify them as either active or passive investment managers. An active investment manager has the performance of their fund measured against an appropriate index. Investment risk for an actively managed fund is the risk that the performance of that fund underperforms that of the index. If the index increases, investment risk is the risk that the fund increases by less than the index or outright falls. If the index falls, investment risk is the risk that the fund falls by more than that of the index. On the other hand, passive investment managers try to track the index by creating an investment portfolio that replicates the index as closely as possible. Investment risk for a passive investment manager is the risk that the performance of their fund deviates from the performance of the index. The implication here is that it's not actually a positive result for a passive investment fund to outperform the index that it's being measured against, because this indicates an issue with the investment manager's replication approach. In the future, this issue may cause the passive investment fund to underperform the index over a certain time period, resulting in very unhappy investors. ESG is a management framework for addressing both the risks and opportunities associated with a changing environment, society, and economy. ESG risks are broad in nature and can influence companies differently based on the unique characteristics of their business, including their industry, what markets they operate in, and the expectations of their key stakeholders. ESG risks can include many of the previously mentioned risk categories, such as regulatory and compliance risks and operational risks. It can also impact financial risks such as credit and market risk, as well as reputational risk. For example, ESG disclosure regulations are going into effect in major markets around the world, making both regulatory and compliance risks top of mind for public companies such as banks and asset managers globally. Operationally, increasing climate impacts like storms, flooding and drought, labour and personnel shortages, and natural resource scarcity are presenting a range of operational risks for companies across industries and in each node in the global value chain. Financially, more and more financial institutions are incorporating ESG criteria into their capital allocation decisions, loan terms, and credit requirements. Investors are also incorporating ESG criteria into their own decision-making and mandates. All in all, a lack of ESG performance could directly impact one's ability to secure investment capital and satisfactory loan terms. Reputationally, ESG has become table stakes. Stakeholders around the world are demanding that companies, such as banks, reduce their negative impacts on the planet and society at large. What's more, the market opportunity for solving environmental and social problems is in the trillions. If a bank is not meeting these expectations, both within their own operations and within their products and services, they could be putting their reputation and intrinsic value on the line.